Hi guys, hope everyone's doing great. We are introducing a new course here. So far the feedback has been great. We are doing a 50% discount sale, first come first serve. It's the Financial Freedom Mortgage Amortization course, and essentially it's just a short detailed course going over amortized loans. Okay, the biggest one of course being a mortgage, which is probably everyone's biggest debt expense. How exactly do we pay this mortgage off sooner? How exactly is it the case that people get themselves into so much trouble with this mortgage? We give you full lifetime access to the spreadsheet, which I'm going to bring in here, which easily is the most detailed spreadsheet you're ever going to find on amortization schedule. I've had a look at the template that Excel can provide you manually. It's nowhere near as detailed as this. When you're paying off a mortgage, perhaps they might give you the first year of how this loan is exactly broken down, but we're not interested in just the first year. We need to know exactly how much interest we are paying. Amortized loans are without a doubt the worst type of mortgage you could possibly get, and we try to simplify everything in this short course. As I said, 50% discount offer, first come first serve. Feedback has been great. Introduction to amortization. We compare amortized loans to simple interest loans. How exactly does an amortized loan differ to a credit card, a personal line of credit, and an overdraft? Okay, it's not necessarily the case that all credit is bad for you. If you misuse credit, like a credit card for example, of course it's absolutely awful. We need to understand the formula and how exactly is changing variables such as time, such as interest rate and deposit amount affecting the mortgage. Of course, we'll go through the calculator in a short while, and then we'll discuss two techniques, the 90-10 rule, as well as making overpayments, and see what effect that has on the mortgage. Finally, we discuss the pros and cons of refinancing and remortgage, which isn't necessarily designed to benefit you, and in fact can actually lead to a situation where all you're doing is resetting the amortization. You're starting the process again from the beginning, on top of that plenty of fees. So we give some interesting thought-provoking ideas as to how people can manage and tackle these loans. Okay, I've never seen a spreadsheet as detailed as this. Now, I initially shared this with my group about 3 years ago, and since then I've now developed it into a short course and have made some changes to it to make it even more customizable and easy to follow. As you can see, we take into account early repayment charges. We have a 10-year summary. We have charts on the right hand side, and we also have left here a notes column as well as equity. If we work on this loan from the top down, let's just go through a hypothetical example to show you what can be done with this spreadsheet. So we have here, the average house price I would guess is $350,000 right now in the US. Okay, 50-year cycle top, mortgage rates are increasing, yields are increasing. Clearly, a spreadsheet like this is going to help to keep you on track of things, okay? Especially if you didn't fix a 30-year mortgage 2 years ago when they were at all-time lows. So, property value $300,000. We're putting in $100,000. Obviously, 33%, it does it for you. It does that for you too. And then here we go. The first variable that we can change. Well, technically the second, because obviously you want to put in as much money as you can. 25-year term. We then have a starting interest rate. What's so good about this spreadsheet, it accounts for both fixed mortgage as well as a variable rate mortgage. So this currently is fixed to a 2%. But what if that 2% is only a teaser rate? Well, here, after any month, you can actually add in the new percentage after that date. Let's say it's 2% for 2 years, after which point it increases to 3.5%. The spreadsheet takes everything into account. What if after year 5 it changes to 5%? Everything changes with it. The mortgage payment, the interest, the principal, the equity, fully customizable, and certainly it is one of the best spreadsheets out there. Now, let's just go back to the 2-year fixed. So let's just think about this for 1 second. We are getting 200 grand over 25 years. Let's just show you some of the changes you can make, okay? Once again, everyone should have this when they're discussing with their finance broker. Okay, you need to figure out exactly how the interest rates and the payments change based on the change in variables. If I got this loan over 30 years, suddenly I'm paying an extra 12 grand in interest. The charts here help to represent everything for you: the loan balance, the cumulative interest, and the cumulative principal. What if I got it over 20 years? Suddenly I'm paying only 42. Okay? We can also, of course, change the starting interest rate, and we can see how this affects everything. Okay? Notice in this case, it's very much inverted. Obviously, I doubt there's anyone out there getting a 4-year. Technically, the California fixed rate mortgage, the last time I saw it was at 6%. So actually, this is a very real example here. 25-year at a 4-year fixed at 4%. Notice how the lines cross over. Very much how student loans work, by the way. Easily the worst type of amortized loan mathematically. They are never actually designed to be paid off. Student loans, the invisible tax, which has basically enslaved the Western world and a whole generation of people, unfortunately. They very much look like this. The two lines have inverted, okay? Ideally, we don't want this situation with the graph. Now, we discuss all of this, of course, in the masterclass. What exactly is a good loan to get over how many years, and how do you want your graph to look? Well, it definitely can't look like this. Anyway, let's not go off topic here. So, we're at 2%, 25-year fixed. Let's bring it back to here. So, the spreadsheet gives us an idea of the total payments, the total interest, and the actual interest rate you are paying. Unbelievably, what may start off as a 2%, technically, you are paying 27 cents for every $1 borrowed. You can see how useful a spreadsheet like this would be. It also, unlike other spreadsheets out there, it takes into account overpayments for the whole course of the loan. By the way, you can use this spreadsheet up to a 40-year loan. I'm guessing there's no one out there who's going to fix a mortgage for longer than 40 years, right? If you put 100K down, double click, you make an extra $100 payment alongside your principal payment of $847. This is a standing order you set up. You can see the change in the principal and the interest payments. Okay, they've gone down massively. In fact, if I just increase that to 1,000, just to show you the little kink in the graph, and you can see it here. You can see the extra payments coming into here and then knocking down the loan balance. Okay. Wouldn't everyone love a spreadsheet like this? I think it's a very useful spreadsheet for everyone to have. Just going over this first example here, 847 of your post-tax income is going towards this mortgage. Does that not worry some people? What is that percentage-wise? 333 over 847. Well, we'll have a look at our summary here. A gigantic $4,000 of free monopoly money. Do not pass go, do not collect $200 here. $4,000 is going towards the bank manager's back pocket, basically. That's not going towards anything. That's just, monopoly money. Much like most of the financial system, it doesn't actually exist. It's not on the elemental chart. We're here to discuss the ideas as to how to get this interest rate back. Now, the feedback has been very good so far, and people are asking for credit cards to go over personal line of credit, and there's various things you can do. Things like velocity banking, infinity banking. There's various strategies which we can do. That'll come in part 2. I just want to start off nice and easy here to see what everyone's feedback is, and if the feedback is also good, now that I've promoted this on YouTube, of course, we can eventually do a part 2. How exactly do we get the $4,000 back? Why exactly is nearly 40% of this 10K of your hard-earned post-tax income going towards interest? Shouldn't be the case. Here we have a few more tables there, and this right here, this really shows the damage that an amortization loan can do for you. If it was a linear loan, we would expect the interest to change in a linear way. But look at this. It's nowhere near linear. In fact, it's the exact opposite. It's exponential here, right? They've compounded the entire interest over the course of this loan and they've front loaded all of it, why are people paying by year 5 1/3 of the interest? What do people usually do after year 2 to 5? If they're lucky, they'll remortgage. But is remortgaging just a simple sign on the dotted line? Sure, you can save money when you're remortgaging. Sure, interest rates have been going down for the last 40 years. They're not going down right now. They're only going to be going up, probably. What is the damage with remortgaging? You're resetting the amortization. And effectively, by remortgaging, whilst you may have ended up here somewhere and paid off a good amount of the interest, notice how it's steep at the start, the interest line, then it flattens out. Okay? They bring you right back down to the start. They charge you an extra $100 in broker fees, product fees. I never understood that. Why is a mortgage regarded as a product? Fascinating. They always try and get people with the jargon. Unbelievably, after year 10, you have paid off nearly 2/3 of the interest. Come back in 2 to 5 years, let's remortgage, let's get you right on the start. They always keep people on the hamster wheel. Anyway, as we move down to here, we have a couple of charts here: actual interest rate, cumulative interest rate, the lump sum to actually end off this loan, and the cumulative principal or the total principal. We also take into account early repayment charges, because obviously there's going to be a lot of savvy people out there who are paying off this mortgage sooner by making extra payments via standing order, and we discuss all of this here. Automatically it works it out. If your interest rate charge is 5% the first year, notice how the interest rate early repayment charges are tiered, right? Because the loan is front loaded. As each year goes by, percentage wise, you're kind of paying less and less. It's absolutely vital in the first, in the first 2 to 5 years of any amortized loan. Usually people will get a mortgage somewhere between 20 to 30 years. I mean, the interest payable in the first 2 to 5 years, absolutely vital you reduce that. But how would you ever know what the interest is? Most people don't have a clue. I mean, I've discussed this spreadsheet with people over the last 10 years. No one honestly has a clue, and the amortization breakdowns that I've seen, at most, they might share with you, honestly, just the first year. I highly doubt they're going to print out reams and reams of paper and share with everyone the total amortization schedule. And if they do, they've not typed it up for you. It's not customizable, right? They've just given you a printout. It really is a powerful spreadsheet, and there's lots of interesting things you can do with it. Anyway, finishing off here, we have the balance, the cumulative interest, cumulative principal, and how much equity you are actually building. And that's what it's all about. We are here to pay off the principal, and we are here to somehow devise techniques to reduce the interest burden. Okay, without a shadow of a doubt, the biggest expense most people have is probably a mortgage, and this is why we have developed this course. Like I said, I've shared it with the group a long time ago. Since then, it's been changed a few times, and everything is customizable. Let's just go with 350 here, right? That's the average house price in the US, probably going to top in Q3 23, as I've been saying for the last 5 years. And here, mortgage rates, well, they're not really at 2% for a 25-year fixed, are they? Let's say you get a 30-year fixed. I mean, in California, it's 6% right now. So let's just take a 3% there. And there you go. And let's change that to a fixed. So do you see? So, if you're going to get a mortgage, my opinion is you need to have this spreadsheet in front of you, but not just a mortgage. What if it's a personal loan? What if it's a car on finance? I think everyone should have the financial education to not only learn how to read a chart, which is what we mostly do on this channel. They must understand the other side of that formula. Increasing your income, not reducing, increasing your income, but reducing your debt expense. Well, there you go. We've got everything in front of you. I've just typed in a few extra things. Suddenly, I'm paying $139,000 on this mortgage. Okay? Anyway, I think we can see there the power of having access to a spreadsheet like this. Like I said, so far, the feedback has been great. It's only $29, which includes the 50% discount code. Clearly, I'm just giving it away for that price. You know, I could probably sell it for double or triple that, but I think everyone should get access to it. So get it while you can. And we will be looking at eventually doing a part 2 where we discuss personal lines of credit and credit cards. But of course, the courses that I develop, they do take time, and I want them to be perfect, basically. So if you guys are interested, if you guys have a mortgage, or simply you're looking to buy a house, perhaps soon, at the top of the property market, then perhaps this is a good spreadsheet for you to have on your side. You do get access to it lifelong. Any modifications that I make to it, of course, they will be free. Any new modules, they will be added. Part 2 of this mortgage amortization course will discuss all other forms of credit, be it credit card, overdraft, line of credit, as well as HELOCs. And there's lots of fancy things you can do where technically you can take one institution's money and pay off another institution and try to become your own bank. Anyway, I'm going to wrap it up there, and I'll catch you guys on the next video. Click on the links below if you're interested.